Grace Gu is an associate professor of economics at the University of California at Santa Cruz. Her research focuses on international finance and macro labor using dynamic programming and micro-level data. She has recently been working on the impact of climate risks from economic perspectives. Grace, thank you so much for taking the time today.
Yeah, you're welcome.
So to start, I'm curious, I've been asking questions about money and climate change recently. Should we print money to more adequately address climate change?
So this is a quite a complicated question. Um, from person. So my view here doesn't represent the university views, or it's only my personal research views. Um, I think central bank around the world, they are, not just talking about the Federal Reserves here, but also ECBs. They are addressing crisis in the short terms. So the function of the central bank is not trying to fine tune the economy, but to combat crisis, right? So when we think climate crisis, it is, we do believe that climate change is a huge crisis for humanity. But it's the central bank's job definition right now does not include addressing a long-term climate crisis. What's the central bank's mandate right now is to maintain price stability and to combat unemployment, as well as output deviations from long-run sustainable output, right? So by the job function, central banks right now does not have a mandate for combating climate crisis. And as I said, from the beginning, central bank is addressing short-term crisis, but climate crisis, in my view, is more a longer run crisis, right? So it is a boiling pot that's boiling for a longer period of time than a crisis that's going to last for a few years, like the past financial crisis and so forth, right? So so from this perspective, I think central bank do not have the mandate right now to, or the function right now to address climate crisis. And also there's the questions about how to use central bank to address the climate crisis properly if we do want central banks to, if we, for some reason, we put the climate crisis into the central bank's job function, right? So there's lots of question about that. How much money the central bank needs to print in order to address the crisis, and how the money should be allocated to what kind of investment, right? So those are the questions that it hasn't been figured out, right? So to jump into, to jump the central bank into this kind of function needs a lot more careful thinking about how central bank should address the climate crisis. However, part of the central banks, including the Fed function, is to maintain the stability of the financial sector, right? So there's banking sector's risks, right? So from that perspective, a central bank could supervise all different kind of risks that banking sectors face, right? I think that should include climate risk, especially for smaller banks, because we all know that global banks, they are much more geographically diverse. And so, they are diversifying their climate risk by allocating their assets across different areas, right? Of very broad regions. Whereas smaller banks that operates more regionally, their assets could be much more concentrated geographically, right? And so they could be more exposed to climate risk at local areas. And so those smaller banks, I think that's where the central bank needs to pay more attention to in terms of their climate risk. But right now, I don't think the central bank should print out money to address the climate crisis because it's a long run crisis. And also there are side effects of that printing money to address climate risk, right? Because people would wonder how that's affecting inflation and impact the economy, because controlling inflation is part of the mandates of central bank, right? Printing money will lead to inflationary pressure when the economy is not in crisis, right? Not in like a financial or economic crisis, right? So there are so much considerations. So I don't think central banks right now, their function should be combating climate crisis, but I do think this is my personal opinion that this could be quite drastic. I do think there are those long-term crises, economic crisis or climate crisis. They are not adequately addressed by the society overall, right? I think those long-term problems should be addressed perhaps by a government agency that's set up to focusing on those long-term problems like inequality, national debt, as well as a climate crisis, to focusing on agency that's specifically targeting at those long-term problems, right? But that's I haven't seen the U.S. doing it or other countries as doing that, because a lot of times the political appointees or administrations, right? They change every few years, and they may not necessarily focusing on long-term perspectives of a country's development, right? And central bank is mainly focusing on the banking sector's sustainability and addressing the short-term crisis, right? So I think there needs to be an agency where long-term crisis is the focus, right? Coming back to climate crisis, I also think private sector could do better. So if you look at the all the people with a decent amount of income, or a top 10% of income households, they would put their money invested in financial institutions, right? Either as deposits or investing in mutual funds, and they put their money in financial institutions, right? And that's about the assets that held by those financial institutions, globally is about $100 trillion, right? And according to IPCC, which is a international intergovernmental panel on climate change, they estimated that about $6 trillion per year is needed to address climate change right now, right? So think about that $6 trillion out of those $100 trillion assets that's been invested, that's been in the financial institutions, just 6%. If 6% of those money could be invested in green initiatives or technologies that promote green innovation, then we'll be on a much better trajectory for the future on climate change, right? So, if those financial institutions can just put about 6% of their assets, right, investing in firms that does green technologies and investing in greener firms, then the economy the climate change and the economy gonna grow at the same time, becoming a greener, right? So that requires first, from the financial institutions perspective or banks, right? They need to choose greener projects, right? And then us, right, the investors, right, who put our money into a bank, that we can also look at whether this bank has the tendency to invest more in green projects as well, relative to, dirtier project, right? So as investors or savers, we decide where we to put our portfolios. We can choose those mutual funds and those banks that do better in terms of distinguishing greener firms versus dirtier firms when they make loans, right, or make their investment. Right? So that's something I think private sector should pick up and share the load of part of the greening process that to help with the climate change.
So I think
yeah,
that's
so that's what I think about where the funding, how do we could finance the climate initiatives.
Yeah, and I think that's a good transition to talking about your research. I wanted to ask you about the research that you're doing on the bank's credit supply, and then also you described distinguishing firms, greener versus dirtier firms. Can you talk a little bit about your research around the bank's credit supply and also distinguishing firms by their emission intensity?
Yes. So yeah, this is a great segue to that. My co-author, we have two PhD students, Jing Hong and Bhavya, and my colleague Galina Hale, and we are working on this preliminary research project, which we look at how banks allocate their credit supplies across different firms. And this we distinguish those firms by their emission intensity. Emission intensity here is calculated by a firm's total emission divided by their value added, where you can think about that's the amount of revenue that they have, and then minus the cost. And so basically with this emission intensity, right, we can, when you have a higher emission intensity, that means per output you have, you are emitting more carbon emissions. And then if you have a lower emission intensity, then that means you are a greener firms. And so we try to see whether the banks would, with time, right, whether the banks are gradually shifting their credit supplies to greener firms in general. That's the first question. And second question, we want to see within an industry, right? So say, for instance, within the energy and utility industry, there are some firms that uses renewable energies, and there are firms that uses dirtier energy, right? So within this, within a industry, does the bank's lending distinguish firms in emission intensity or not, right? And then the third question is whether the banks also allocate their lending across industries depending on industry level emission intensity. Okay, so ideally what we want to see, hypothetically, right? This is not necessarily reality, but hypothetically, we will ideally would like to see that banks are distinguishing firms within an industry, right? Because we still, for our consumption, we still need all sorts of industries, right? We still need energy, right? And we still need cars. We still need all sorts of products from different industries. We just want greener products out of each industry, right? And so ideally, we would like to see that banks are distinguishing the greenness across firms within industry, right? So, and ideally, we want to see, it's not ideal to see that firms reallocating their credit by industry emission intensity. So suppose, say, the IT sector is a lot greener than the energy sector. So we don't want to see all the credits are going, reallocated to IT sector and no credit going to the utility or energy sectors, right? Because we still want utility and energy sectors to have credit in order for them to innovate and to become greener, right? So they still need financing for that, right? If you are exhaust them from those financing, and those industry may run the risk of become even dirtier, right? So that's the expectation that we want to see, whether if the banks are indeed making those changes over the years, right? So the results is very preliminary. We are still working on some fine tunes, but roughly, so we're using the European Union and United States syndicated loan data. Those syndicated loan data, they captures most of the big banks lending to companies, tend to be also larger companies as well. And what we found is that for within industries, there are indeed some shifting of lending to greener firms within that industry. So that's good news, right? And those shifts to greener firms within industry tend to happen in the dirtier industries as well. So that's very good news. And this is more prominent, this result is more prominent after the Paris Agreement, but not so much before the Paris Agreement. Okay, so this is some encouraging news. For between industry shifting, the results is more mixed, right? So that seems to be it's promising, right? So the banks maybe are doing something here within industry. They're trying to distinguish the firm's climate risk or their greenness, right? But we do find, I'm sure you or your audience perhaps have heard this term called the Net Zero Banking Alliance. We did not find any significant difference of banks in those alliance versus not in this alliance. So this alliance membership does not seem to matter much to our result. Yeah.
So the when you say the banks are distinguishing at least some of the time, or they're shifting, some of them are shifting, are you able to, is there enough granularity that you're able to see whether they're shifting only because of the desire to green something, or if it's also partly that the investments are becoming more appealing, so they're doing it like, are you able to see their motivations at all? Like, are they doing it partly because green energy or green investments are becoming more profitable or better investments, or are they doing it, like you said, or as a result of like the Paris Agreement? Are you able to tell?
That's a great question. We don't have the data on their motivation in the sense that we cannot see the exact project returns. Um, so we can't compare, whether you make loans for this greener firms versus dirtier firms, their relative returns. We don't know that data. However, we also use a administrative data from Denmark and other countries. So this administrative data is different from the syndicated loan data that I was talking about earlier. The syndicated loan data only composed of large banks, they're lending to companies. Whereas an administrative data, however, have every bank credit supply information that linked with all the firms within the country. And we obtain data for Denmark and a few other countries. So that way we can see the entire country's credit supply distribution across firms by their emission intensity, right? But with syndicated loan data, we cannot do the distribution because it's only part of the credit supply in the economy. You see what I mean? So with the Danish data, we're able to see how does the firm's output shifts for the greener firms, ranking from greener firms to the dirtier firms. We do see there is an output shifting, that there's this more and more output where more and more firms are producing greener products, where there's more and more green firms in the entire economy's distribution. And with that, the credit supply is also moving with the output distribution shifting, right? So that means there's more and more credit supply is going into those greener firms as well. But so we're able to distinguish two kinds of credit supply movements. One is called passive credit supply. The other one is active credit supply shift. So the passive credit supply shift means that the credit supply increasing simply because there's more and more such green firms, right? The output is increasing for those greener products, right? And that's just passive credit supply because it's simply banks' reaction to the production shifts from dirtier to greener, right? And we also constructed what we call the active credit supply change. And so that's the additional credit reallocation going into the greener firms, in addition to the credit increase because of the output change. Okay.
So is that because, so is part of the maybe the active, you mentioned earlier that you said something along the lines of dirty needs finance to innovate. The dirtier firms need finance to innovate to get to green. Is part of the
let me clarify that. So dirtier industries needs not necessarily have to be the existing dirtier firms, but not only them should innovate to get greener, but also there should be newer firms in that industry to innovate for greener technology as well.
But so is part of the credit being utilized for that transition? Is the is the credit just being used to do more of whatever the business is, or is part of it sometimes like is there a subset that
Yes.
is
Yeah.
maybe transitioning from a being a dirty firm to being a green firm or something like that?
Yeah. Yeah. So that's a great question. We haven't reached to that stage. And our next stage of this research is to looking at how the credit supply affect firms' green innovation. Then we'll be pulling data from firms' patents data to see whether those credit injections to a firm would correlate with a firm's increasing in terms of green patents, which is one of the measurement for green innovation. And to see whether, exactly to answer the question that you have, are those credits really helping with green innovation or not? Helping the firms to become greener. But I want to go back to a little bit what I just said about the passive credit supply and active credit supply. So we find from the Danish data that majority of those credit supply movements to the greener firms is actually due to passive credit supply. And there's only a very small share, like 5%, that is due to this active credit supply reallocation. So that means the banks, they're reactive to how the economy's output is going, right? So they're reacting to the banks in Denmark, they're reacting to how the output is shifting into greener firms. That's what triggers majority of the credit reallocation into the greener sector or greener firms.
So you mentioned some of the differences across industries or the way banks think about different industries. In terms of like the emissions intensity and how you calculate total emissions for a given firm, I would think that some firms would have a lot of emissions associated with their energy or their transportation, and if their like electricity provider
Yeah.
were to go greener, then they would by you know by association go greener as well. Is there any visibility on some of that happening where one industry will help another, or one set of firms will help another set of firms, or maybe it's a position in the supply chain or something where you're able to see that there's an impact downstream or upstream of um, firms or industries decarbonizing?
Yeah, so we use the both scope 1 versus scope 2 emission measures. So scope 1 would captures what those traditional dirty industries and for instance mining or oil extractions and those kind of emissions. And scope 2 would including all, for instance, like your bank may have a truck that's also does transportation and those kind of emissions as well. And so in our study, we used both type of scopes to measure emission. So we're trying to capture are the banks are more focusing on scope 1 or they're more focusing on scope 2 emissions. The results didn't quite differ from each other, whichever measure that we use. But that's something that we probably want to fine tune later in our robustness check as well.
Another thing I was curious about is, as you were talking, is there any indication right now or anything that you're seeing that would suggest that greener firms are outperforming dirtier firms?
In terms of their
uh, the performance of their business, whether it be according to profit or otherwise.
uh I don't know about um the answer to that question. Um, Certainly, I think the investors do not think so. There seems to be still a green premium um, that those greener firms that they have to pay a higher premium on the bonds market. But um, yeah, so it seems to be investors don't think so, but I don't have the data myself to speak to that.
So I'm curious, what is the kind of the next phase of your research, or what does the future of your research look like?
So I have quite a few climate related projects in addition to this banking credit supply one. Um, so for one is that we're trying to look at whether households respond to climate disasters such as flooding. And I think one big issue in the market is for insurance company. Insurance companies, there are, so for instance, homeowner insurance, right? If you want to buy a home and getting a mortgage, that you need home insurance. And the homeowner insurance are withdrawing from California for quite some time now because of the climate risk and their inability to price insurance properly. And there has been some recent drastic reform on the insurance market in California that led by the Department of Insurance here. Um, so so it's really interesting to see. So in our study, we're trying to see whether home households response to insurance market premium changes and how that affect their credit as well as their migration decision. But we're more focusing on the flood insurance rather than homeowner insurance. But that there are a lot of ongoing research by others that's looking at the homeowner insurance as well. But in general, I think the insurance market is having a very difficult time because of the climate risk. And I think insurance company, they should also more, since they are one kinds of financial institution, so they should also allocate their assets, investing their assets more to green energies as well, just for their own sake. um, yeah, so that's one household level project that I'm doing that is related to insurance market and climate risk. Um, and then we are also looking at how firms' innovation respond to climate risk, climate disaster as well as we talked earlier, how whether the firm's innovation responds to bank credit to address to conduct more green innovations.
So just one final thought that I had as you were talking, that and kind of to bring it full circle, when you were talking about the central banks, you mentioned risks that are concentrated geographically, and that as you were talking about the insurance, that seems like it would also be relevant. Are you seeing with your research that certain geographies are innovating more, or banks in certain regions are um, investing more in greener firms by geography?
So you mean whether, so suppose like there's a smaller bank that's more operating in California, would they say care more about climate um, than a bank that's located somewhere else that suffers less climate risk? Is
Yeah,
that
or is the Southwest investing in more green companies than the Midwest? Or are you seeing any kind of trends where the green companies that are it's more likely that a green company is invested in if they're or has access to more credit or anything like that if they're in a particular geography or state or something like that?
Yeah, so that's an interesting question. We haven't seen it in our current research using the EU and US syndicated loans. Remember, those banks are they're very large banks, so they tend to very much geographically diverse. Um, but we could look at some of the smaller banks, say in Denmark, where we have the data on all the banks, right? Then we can see if some of the banks are more geographically concentrated, would they react more to supply credit to greener firms? Yeah, that's something we can definitely check. But to answer your question, we did look at that for firms, like non-financial, corporations. We do see that firms that themselves suffered more physical climate risk. So say, suppose a firm was flooded, one of its establishment was, and then they seem to increase their green innovation. So, but that's another ongoing project of my research.
It all sounds super interesting, and I really appreciate your taking the time to talk to me about your research and share your insights. And so I just want to say thank you, and I would love to continue the conversation down the road.
Yeah, of course, my pleasure.